You're scrolling through Zillow at midnight. Again. And every house that doesn't look like a crime scene starts with a $500,000 for 3 bedrooms, 2 bathrooms, and a backyard the size of a parking spot. So you do what every rational person does. You open a calculator, you type in your salary, and the numbers just don't work. Here's the thing though. Most people stop there. They close the laptop, feel defeated, and assume they'll never own a home. And honestly, that's the wrong takeaway. My name is Rick, and today I'm not going to tell you that you can't afford a $500,000 house. You've probably already watched 5 videos that told you that. What I'm actually going to do is something nobody else is doing. I'm going to tell you exactly what salary you need to buy a house right now, break down every real cost most people ignore, and then give you a clear roadmap based on where your income actually sits today. Because the goal isn't to scare you. The goal is to hand you a map. Let's start with the reality of the market, because context matters. In dozens of US cities right now, Denver, Austin, Seattle, anything within commuting distance of a major metro, $500,000 isn't buying you luxury. It's buying you a standard 3-bedroom, 2-bathroom home, roughly 1,200 square feet. That's the baseline. That's what normal costs. The median household income in America sits around $84,000. So we're asking regular people to spend 6 times their annual income on a house. For reference, in the 1970s, the average home cost about 2.5 times median income. That ratio has more than doubled. That's not a small shift. That's a fundamental restructuring of what home ownership means. Now, before we get to what you should be making, let's get brutally honest about what buying a $500,000 house actually costs every single month, because this is where most people get blindsided. The down payment problem. The traditional advice is 20% down. On a $500,000 house, that's $100,000 in cash sitting in your bank account on closing day. The median savings account in America has around $8,000 in it. So the average person isn't a little short. They're $92,000 short. And if you're thinking, I'll just save it, let's run that math. If you earn $84,000 and manage to save 10% of your gross income, which is already more than most people achieve, you're saving $8,400 a year. At that rate, it takes nearly 12 years to hit $100,000, and that assumes home prices freeze exactly where they are today. They won't. So most real buyers put down 5% or 10%, which is $25,000 to $50,000. Still a significant number, but much more achievable. Let's use 10% for our model. The monthly payment nobody shows you. You put down $50,000. That leaves you with a $450,000 mortgage. At current interest rates, somewhere between 6% and 7%, your principal and interest payment lands around $2,750 to $2,900 per month. But here's where it gets real. That's just a loan payment. That's not what owning the house costs. Add property taxes. Conservatively, around $500 per month depending on your state and county. Add homeowners insurance. That's another $250 to $350 monthly. And it's been rising sharply in recent years because of climate-related risk in a lot of markets. Add maintenance. The standard rule is 1% of the home's value per year, which on a $500,000 house comes out to $5,000 annually, or roughly $417 per month. And if you put less than 20% down, add PMI, private mortgage insurance, which runs another $200 to $400 per month. That's a fee you pay every month to protect the bank, not yourself, for the crime of not already being wealthy. Let's add it all up. Mortgage, P&I, $2,850. Property taxes, $500. Homeowners insurance, $300. Maintenance reserve, $417. PMI, $300. Total monthly housing cost, approximately $4,367. And that's a clean month. No HVAC failure, no roof leak, no HOA surprise assessment. That's just baseline. Now, here's the question everyone actually wants answered. What salary do you need to make this work? Financial advisors generally recommend spending no more than 28% of your gross monthly income on housing. Banks will approve you up to a 43% debt-to-income ratio. But there's a massive difference between what a bank will approve and what won't destroy your financial life. Let's reverse engineer this. If your total housing cost is $4,367 per month, and that represents 28% of your gross income, the financially healthy threshold, you need to be earning about $187,000 per year. If we use the more lenient 43% bank standard, you'd still need to be pulling in around $150,000 annually just to technically qualify. And here's the punchline that everyone glosses over. Only about 10 to 20% of US households earn $150,000 or more, which means somewhere between 80 and 90% of American households cannot comfortably afford a $500,000 home under any reasonable financial framework. Not because they're bad with money, because the math structurally doesn't work. So let's build the actual income tiers. Here's your roadmap. This is what nobody else is giving you. Instead of just saying you can't afford it, let's map exactly what's realistic at different income levels and what your actual move should be. Tier 1. Household income under $80,000. Let's be straight with you. At this income level, a $500,000 house in a high-cost market is not an option right now, and pretending otherwise will set you back years. Here's what the math looks like. After taxes and modest retirement contributions, a household earning $75,000 to $80,000 takes home roughly $4,800 to $5,200 per month. Your total housing costs on that $500K home would be $4,367. That leaves you roughly $800 to $1,000 for everything else in your life. Food, transportation, healthcare, utilities, clothing, all of it. That's not tight. That's impossible. Your move at this income level, first, resist the pressure to buy in a market that doesn't fit your numbers. Renting is not failure. Renting while you build your financial position is strategy. Second, identify your actual target price. At this income, a home in the $180,000 to $220,000 range may be realistic. That might mean a different city, a smaller market, or a smaller home, but that's a real path forward, not a compromise. Third, focus on the two levers that actually change your situation: increasing income and building a down payment fund. Even getting your income from $75K to $100K changes your math dramatically. Skill development, certifications, job changes, side income. This is the season to invest in your earning power. Fourth, open a dedicated high-yield savings account just for your down payment. Treat it like a bill. Automate it. If you can put $600 to $800 a month in there, you're building real momentum. The goal at this tier is not to buy a $500,000 house. The goal is to set yourself up so that in 3 to 5 years, your options look completely different. Tier 2. Household income $80,000 to $120,000. You're in the most frustrating zone. You earn decent money, you've done a lot of the right things, and yet the market still feels out of reach. That frustration is valid, and it's not just in your head. Let's look at the numbers for a household earning $100,000. After taxes and modest retirement contributions, you're taking home approximately $6,200 to $6,600 per month. Your housing cost on a $500K home is $4,367. That leaves about $2,200 for everything else: 2 car payments, insurance, groceries, utilities, student loans, healthcare. It doesn't work, and anyone who tells you to just budget better is not doing the math. Your move at this income level, you have 2 realistic paths, and you need to honestly evaluate both. Path A. Adjust the target price. A household earning $100,000 can genuinely afford a home in the $275,000 to $325,000 range, while maintaining real financial health, an emergency fund, retirement contributions, and the life. That might mean a different neighborhood, a different city, or a smaller home, but it's a home you actually own without it owning you. Path B. Build toward $500,000 by closing the income gap first. What would it take to get your household income from $100K to $140K or $150K? Is that a realistic 3-year target? If yes, the move might be to keep renting, invest the difference aggressively, and buy when your income actually supports it. One thing to strongly consider at this tier: dual income households have a significant advantage here. If you and a partner can combine income toward $130,000 to $150,000, the math shifts meaningfully. But even then, and this is critical, you need to stress test the plan on one income. Life happens. Jobs change. What happens to the mortgage if one of you loses income for 6 months? If the answer is we'd be in serious trouble, that's information you need before you sign. Tier 3. Household income $120,000 to $160,000. You're getting into the territory where a $500,000 house is possible. But possible and smart are two different things, and the line between them is thinner than you think. Let's run the real numbers for a household at $160,000. After federal and state taxes, FICA, and a reasonable 401k contribution, you're taking home around $9,500 per month. Housing costs of $4,367 leave you $5,133 for everything else. Now subtract the real life expenses. 2 car payments at $800, auto insurance at $250, gas at $300, student loans at $600, health insurance premiums at $400, groceries at $800, utilities and subscriptions at $450, you're left with about $1,533. That's $1,533 for clothing, kids' activities, car repairs, medical copays, date nights, travel, and most importantly, building any kind of savings buffer or investment beyond your 401k. This is the scenario that traps people. They earn good money, buy the house that the market tells them is normal for their income, and then discover they're one HVAC failure away from credit card debt. Your move at this income level? If you're at $120,000 to $140,000, be honest about the margin. A $500K house might technically work, but you'll be stretched. Consider whether there's a $380,000 to $420,000 option that accomplishes most of what you want, but gives you breathing room. If you're at $150,000 to $160,000 household income, and both earners are stable with strong job security, a $500,000 home can work. But only if you go in with eyes open. That means a 6-month emergency fund before you close, not after. It means retirement contributions don't stop. It means you've actually run the monthly budget on paper and know exactly where the $1,500 buffer goes every month. The mistake at this income level isn't buying, it's buying without enough cushion to absorb the surprises that home ownership always delivers. Tier 4. Household income $180,000 and above. At this income level, a $500,000 home is genuinely, comfortably within reach. And you probably already know that. After taxes and contributions, a household at $180,000 takes home roughly $10,500 to $11,000 per month. After $4,367 in housing costs, you have $6,000 to $6,600 remaining for all other expenses. Run the same monthly expenses we outlined earlier, and you're left with $2,500 to $3,000 of real margin. That's money for savings, investments, life, and absorbing surprises without a crisis. Your move at this income level. The financial math works. The main risks at this tier are behavioral, not mathematical. Overextending on a more expensive home just because you qualify. Undersaving on the down payment to buy sooner. Treating the bank's maximum approval as your target. At $180K plus, the discipline is resisting lifestyle inflation in the purchase itself. A $500,000 home might be well within your means. A $700,000 home, because you qualify, might put you right back in the stress zone of lower tiers. Buy what your budget supports comfortably, not the maximum the bank will give you. Here's something important to understand before you ever walk into a lender's office or sign a buyer's agreement. Nobody in the home buying transaction has a financial incentive to tell you the truth about what you can afford long term. The seller listed at $500,000 because that's what comparable homes sold for. The bank approves you up to 43% debt to income because the loan won't immediately default. The real estate agent's commission is a percentage of the sale price, so they benefit when you stretch. And the mortgage broker gets paid when you close, not when you're comfortable 10 years from now. The entire system is designed to get you into the house, not to ensure you can afford the house and still have a life. This isn't a conspiracy, it's just incentive structures working exactly as intended, in their favor, not yours. Home prices have increased roughly 400% since 1990. Median household income has risen about 180% in the same period. That gap is not something you can save or hustle your way out of. It's structural. It's real. And acknowledging it isn't pessimism. It's just being honest about the landscape you're navigating. Once you sign those papers and move your furniture, you're locked in. You can't just decide 6 months later that this was a mistake without destroying your credit and losing your down payment. So the time to run the real numbers is now, before you're emotionally attached to a specific house.
Let's talk about what people get wrong about homeownership and wealth. Buying a house you can comfortably afford builds wealth. Buying a house you can barely afford destroys it. The wealth isn't in the home itself, it's in the margin your budget has left over after the housing payment. Margin is what lets you invest consistently. Margin is what keeps an unexpected $3,500 repair from becoming a credit card spiral. Margin is what lets you contribute to retirement without cutting from somewhere else. Margin is what makes you financially resilient instead of financially fragile. Real wealth is freedom, not equity you can't access because you're trapped by the asset that's supposed to be making you rich. So here's the framework I want you to walk away with.
The right house is the most expensive house that still leaves you margin, not the most expensive house you qualify for, not the house your friends bought, not the house that looks good in Instagram stories, the house that keeps your financial life functional, flexible, and moving forward. That might be $500,000. For some of you watching this, it genuinely is. But for a lot of you, it's $280,000 or $350,000, or it's continuing to rent for another 2 years while you close the income gap. There is no shame in that. There is no trophy for being house poor. The stress of barely making your mortgage every month will erase any pride you felt the day you got the keys. So let's bring this home, pun intended. If you took nothing else from this video, take this. Stop asking, what will the bank approve me for? And start asking, what can I genuinely afford while still building wealth, staying out of crisis, and living an actual life? Those are two catastrophically different questions with two very different answers. Run your real numbers. Use a tier system we laid out. Be honest about your income stability, your savings cushion, and what happens if one thing goes wrong. And if the math doesn't work for a $500,000 home right now, walk away. Your time will come, and it'll come a lot faster if you don't wreck your financial foundation chasing a house you can't actually support. If this helped you think more clearly about where you actually stand, hit subscribe. I put out honest financial content every week with real numbers, not wishful thinking. Drop your city and household income in the comments and let me know which tier you're in. I read everything. And I'll see you in the next one.